All right. Hey, everybody. Thanks so much for coming out. So obviously there's been a lot of news lately around stablecoins. When we first started thinking about doing this event was when Gemini announced they're doing a stablecoin just a couple days ago. Coinbase mentioned they're doing a coin. There's tons of projects, and I feel like from what I hear from people, there's maybe not a lot of understanding about necessarily how they work, what they are, what the benefits are. So we thought we'd do an event, kind of educational, talk about these, have a couple of really great speakers working on projects at the forefront of this who have released coins out in the wild, real world experience. So before we get started, I just wanted to, we usually do a thing called lightning talks, so we get a minute to kind of talk about a project. I know Aaron wanted to mention his, so just a round of applause, and we'll take care of that. Thank you, Aaron.
Hello, everybody. You guys, many of you may have already heard me give this talk because I'm here every month. But I am one of the partners at a bar in San Francisco at Bush and Taylor Street. It's called Stuckey's Club Moderne. It's a 1930s concept bar, but we are the only bar in San Francisco that takes crypto. We take Bitcoin. So bring your Bitcoin and bring your Ethereum, bring your Litecoin. Those are the 3 coins we take. And come also, you can bring them anytime, but there's also a third Wednesday of every month, we have a special San Francisco Bitcoin Meetup happy hour. It's unstructured, there's no talk. Just come on in, have a drink, talk to other people you know there. And yeah, that's it. Thanks. 895 Bush Street at Taylor.
Thank you. So the format we're going to do tonight is we're going to have 2 short presentations from our speakers just to kind of go over their project, get a sense of who they are and what they're talking about when we do our panel later. So, and then we'll save questions for the end. So if you think of a really good question, write it down on your phone or something. And then we'll bring both speakers up and we'll do Q&A, and we'll go from there. So with that, let's go ahead and kick it off. Our first speaker today, Nick from MakerDAO. Thank you.
Okay, cool. Okay, hey guys. Kind of quick show of hands, who here has heard about Maker or thinks they kind of know how it works? Okay, cool. That's pretty good. Usually we're one guy in the back, waving his little hand around. Awesome. Okay, so kind of, what is MakerDAO, fundamentally? And really, it's kind of this open, inclusive platform for stability. And at the center of this platform is DAI. So DAI is a kind of decentralized medium of exchange. Decentralized in that you own your own money. No one can take it away. No one can censor your transactions. It's yours. And the most important thing to know about DAI is that DAI is $1. Okay, so kind of why do we need a stablecoin? I know you've probably been hearing a lot about stablecoins in the news in the past 6 months. So if I sound like a broken record, I'm sorry. Just let me get through this. But basically, crypto has this kind of fundamental problem of volatility. So here you can kind of see a price chart of Bitcoin and of Ethereum, right? And this is graphing the daily percentage change. Right, so you can see that they're extremely volatile. And this makes them not very good to use as kind of a medium of exchange. So when I say a medium of exchange, what do I mean by that? So let's say something like e-commerce, for example. A merchant doesn't want to be paid in a Bitcoin or in an Ethereum, right? Because tomorrow the value could drop 10, 15%. Right? And a small business can't really withstand those kinds of margins on their profits. So instead, if you had something like a stablecoin, something that actually retains its value, this is really kind of the catalyst that is going to enable e-commerce to happen in kind of the crypto sphere. And so, how does DAI work? So you can imagine kind of the gold standard, but with any asset. So for those of you who are unfamiliar with the gold standard, right, basically from the late, I want to say 1830s up until 1976, most of the world was on the gold standard, which pretty much meant that money was backed by gold, and that's why you could trust money to have value, right? With DAI, we're kind of going for this very same thing, but instead of saying why, we just say why not? Why just gold? Why not just be able to use any kind of assets? Why not be able to use new kinds of synthetic assets? And I'll touch on more of this in like a little bit later. So going back to how DAI works, basically this is the only jargon I'm gonna make you guys learn. It's called a CDP. I promise. It's the only one tonight. And a CDP stands for a collateralized debt position. And essentially what a collateralized debt position is a smart contract, and you lock up some kind of collateral, so say Ethereum, and then you can borrow the stablecoins against that collateral. And what you'll notice is that the collateral on the left is worth more than the kind of loan amount in the stablecoins on the right. And this is kind of a fundamental property of why people can have faith in DAI having $1, because there's more than $1 worth of assets backing DAI. That's why you can trust that it has at a minimum this kind of floor price of $1. And this is kind of analogous to a mortgage. Sometimes it helps people to think of it this way, right? You go to a bank, you're saying, okay, I'm going to put up this house as collateral, along with my down payment, and I want to basically take out a loan against this home and my down payment. And if I don't pay back the loan, right, the bank can basically liquidate my loan by basically seizing the house, right? So I want to kind of emphasize this point a lot, because Maker is not just a stable coin. Like what I've just shown you, while it seems really, really simple, is actually a really, really powerful concept that enables Maker to be this kind of global decentralized credit system. And one really useful kind of property of this, right, is that it's this open platform, right? Anyone in the world can access it, and now anyone can kind of gain equity from their assets. Right? You don't have to go to a bank anymore or have some kind of relationship with the bank. This is an automated system where you can go lock up collateral and basically take out and gain access to a line of credit for the assets that you have. And one kind of really unique property of this system that this kind of enables that hasn't been done before is you can do decentralized margin trading. So essentially how this works is you take your Ether, you lock it up in a CDP, right? Let's say you have $100 worth of Ether, right? You can now borrow, let's say, $70 worth of DAI against that Ether. And now what do you do with that DAI? Well, you can buy more Ether. Okay, so now you'll notice that you have more Ether in total than before you started. So you basically have a leveraged position on Ether. You are margin long on Ether. So basically any asset that is accepted as collateral in the DAI credit system can basically be used to, for someone to be able to gain kind of long positions in this asset. And you'll see that this is kind of connected. Like you can do this on loop, right? So that Ether that you just bought with the DAI, you can redeposit that Ether into the CDP and draw even more DAI and kind of do this ad nauseum. And you're taking on more risk, but it's kind of controlled in the sense that you gain exactly how much leverage you want to take on. So kind of there's the other side, right, where what if the value of the collateral drops? So say, in our previous example, you had $100 worth of Ether and you took out $70 worth of stablecoins. Let's say that the value of Ethereum drops, right? What do we do in that case? Well, essentially, we have to liquidate you. It's essentially like getting margin called. So what we do is basically we seize the collateral and we auction it off to get back the outstanding debt, right? The outstanding number of DAI. And after we've gotten back that debt, then basically the remaining amount of collateral you get back. So where are we now? So DAI is live right now. We launched DAI back in December of 2017. Since then, there have been created about 65 million DAI, backed by, I think it's about 1% of all the Ethereum in existence is now locked up in CDPs. So that's a pretty cool statistic for only having been live for less than a year. And so what happened in that time, right? So this is a graph of the price of Ethereum, and from when we launched to about right now. And you can see that, the price of Ethereum crashed, right? And so as you can imagine, a lot of CDPs, a lot of loans got liquidated over that time. But so how did DAI kind of do during this whole kind of ordeal? So this is a price graph in green of DAI during that time period, and it's remained stable kind of throughout. And if you look at the blue line is the kind of amount of DAI in circulation. You'll see that it's had a pretty consistent slope in trending upwards. So that's kind of our journey from 0 DAI to 65 million DAI today. And okay, running out of time here. So wrapping up, kind of what's next for DAI? Well, our big thing right now is multi-collateral DAI. Multi-collateral DAI is going to expand kind of DAI to not only be able to be backed by DAI, but to be able to be backed by all kinds of tokenized assets. And why does that help us? Well, from a risk perspective, we don't want DAI to just be backed by one asset, and neither do we want DAI to just be backed by kind of correlated assets. And the reason this is important is pretty much diversity, right? You don't want to be dependent, have your stablecoins peg be dependent on the price of Ether, right? If Ether were to have a black swan event and crash, 90%, right, the peg might be broken. So what multi-collateral DAI enables us to do is to start using all kinds of different assets and kind of adjust the risk exposure of the total collateral portfolio kind of that we have. So you could imagine, say there's a cap of 9% of the total portfolio can be Ether, and 3% of the total portfolio can be Omise Go. And maybe we want some exposure to gold. So we say that right, Digix should have a 6% exposure in the collateral portfolio. And the sky is the limit here in the sense that, right, any kind of asset that or not even asset, just like security that you can tokenize. You can tokenize a stock, you can tokenize a bond, you can tokenize a derivative, you can use any kind of synthetic assets, you could tokenize real estate. All of these kind of new kind of tokenization models coming live is just going to improve the stability of DAI over time. And so if you're interested in what I had to say, if you want to learn more, you can go to MakerDAO.com. You can also check out our subreddit or our Rocket Chat. We're extremely active on both of them, like all the developers, all the founders, all the biz dev guys. So you have any questions, we're more than happy to help you out. And if you really liked what I said and your mind is blown and you want to help move this forward, come work with us. We're hiring kind of across the board right now. We're currently at 80 people. Within the next year, we want to double that. And so we're hiring across the board. So if you're interested, if you have a lot of experience, come talk to me, visit our site. Let's do this.
All right, so we'll bring it back up at the end for any questions. For now, let's go ahead and just jump to our next project. Please welcome up Danny.
Cool. Awesome. Hey everyone, I'm Danny. I'm the CEO and co-founder of TrustToken and TrueUSD. How many people have heard of TrueUSD? Awesome, that's a good crowd. Cool.
I might have to click twice to get it going at first, but yeah.
All right, so quick background on TrueUSD is it is a fiat-backed stablecoin, and so this is the market trend we see coming forward. We launched in March, initially on Bittrex. Now we're the second largest stablecoin in the marketplace for fiat-backed stablecoins, just right after Tether. And so there's a circle over there that sees this spike. Does anyone know what happened at this volume where it spiked up to $70 million approximately a week and a half ago? Yeah, what happened? Why was there lack of faith in Tether? There was a what? Premium for Tether? Yeah. There's no transparency. Noble Bank. So there was news that came out early October that Noble Bank was no longer servicing Tether, which was the bank that people thought was banking Tether. What else happened? Cool. So what happened was on Sunday night, approximately a week and a half ago, I got a call Sunday night that said that Tether was trading at 80 cents on OTC markets. And so people were starting to become very, very fearful, and the week before, they were trading at 97 cents. And so there has been a slow lack of faith in Tether, and what we saw was something like a small bank run. And so Tethers started trading around on the exchange prices, something around 90 cents for a whole week. And so people in China, particularly in the Asian markets, were scrambling to get out of Tether, thinking that the whole thing could fail. And how much did Tether market cap lose over the last 2 weeks? Does anyone know? What was the original market cap 2 weeks ago? 2.8 billion. What's the guess for what it is now? So it's at 2 billion. It just went below the $2 billion mark. And so during that time, people were looking for alternatives. And so this was quite the scrambling period where we have one trader that's processing OTC desks. And the way that we work is that people can either give us crypto, like Bitcoin or Ethereum, or wire us US dollars into an escrow account opened by our fiduciary and bank partners. And then those partners notify us to mint TrueUSD. And so we can mint ourselves TrueUSD and sell these for crypto, and that's how we move TrueUSD into circulating supply. And so there's more and more stablecoins coming out, and the one that has the most faith are the ones that are being purchased, and the ones that have the least faith are being kind of redeemed and dropping out in market cap. Cool. So some stats on TrueUSD. It's the second largest stablecoin out there in market right now. It's $165 million. We launched in March. We have about a trailing monthly average of $500 million volume, and it's listed across a lot of exchanges. This past week, we're listed on OKX and Huobi, which are the second and third largest exchanges. We're on Binance, we're on Bittrex, and so we are the second most listed stablecoin right after Tether as well. Cool. And so how did this all start? And so has anyone heard of TrustToken? Okay, a couple hands in the background. And so TrustToken is actually where we started off with, and it's an asset-backed token platform. So we make it very easy to turn real-world assets like gold or US dollars into tokens like USD coin or gold token. And the first thing that we created is TrueUSD, which is a USD-backed stablecoin. Cool. And so the background story of how we got to TrustToken was I met my co-founder Raphael about 3.5 years back, and he had just graduated from Stanford studying computer science, and he had a couple of job offers that he could defer from places like Google Brain. And so he decided to start sleeping in his car and thinking about what technologies would have a massive amount of impact in our lifetimes. And so I was also traveling around every weekend and coming back to the Bay Area only a few weekends, and I would sleep in my car as well. So we decided to team up and sleep in our cars and deploy a strategy we called low burn rate, high variance strategy, where we would look at all these technologies and build a lot of code and try out these technologies and learn what we thought would have the most impactful technologies of our lifetimes. And so we looked at artificial intelligence, brain-computer interfaces, biosynthesis, and of course, Ethereum and cryptocurrency during that time period. And then Raf went to work at Google Brain for machine learning research for about a year, and I went to a neural implant startup called Kernel, which got $100 million to stick electrodes into people's brains to mathematically model what happens when you shock certain parts of the brain. So I was the first engineer there, and we took a lot of neuroscience data and started building models of the brain. We did that for about a year, and at the time, we had explored all these technologies, and we became more convinced that cryptocurrency was going to have a lot more near-term impact soon. And so about 2 years ago, we raised a seed round from Founders Fund, Angel, and Stanford StartX. And what we were excited about for Ethereum specifically was we saw it as this world computer that would run humanity's most important computation. And when we asked ourselves what's actually going to run on a world computer, it was pretty clear that the primary use case of digital assets like Bitcoin and Ethereum was trading them back and forth, essentially logging financial transactions. And when we looked at today's markets like the New York Stock Exchange, everything that's traded is real-world assets and their derivatives. It's $250 trillion worth of real-world assets. And so we looked at cryptocurrency, which was just a couple of dozens of billions, and we looked at all the world's assets, and we thought, it looks like there could be a new global financial system emerging on a global platform. And that one of the largest opportunities in the space would actually be not what's traded with kind of native crypto digital assets, but what could be transferred from the traditional financial system into this new open financial system. Cool. And so we landed on our mission and vision. And so our mission is to open access to financial opportunities in global trade. And the way that you can break that down is financial opportunities are about market cap. So we are creating more and more asset-backed tokens that allow people to access capital markets and also access investment opportunities. And so we are trying to create a platform that in aggregate transfers more and more value from traditional systems, the traditional financial system, to the open financial system. And the global trade really is an aspect around volume. We think that liquidity allows for better price discovery, but more importantly, allows for economies to trade with other economies to be able to sell scarce resources or surplus resources to nations that have less scarce resources for those. To sell surplus resources or surplus resources to nations that have to have more cost to build those particular resources. Our vision is to shift more and more money and value into the open financial system. Cool. And so we started off with currencies because we saw that there was more regulatory clarity, and there was also clear demand by Tether. And we thought that there was already a $2 billion of Tether that had clarity around what we could do to improve the current status quo of what Tether offers right now. And we started off with currencies, and our plan is to move into more and more complex assets. So the way to think about asset complexity is how much information you would need to know from me if you were actually buying those assets. So currencies are generally all the same. And so if you're buying US dollars, you don't really have to ask what's the difference in that US dollar versus another. But if you're buying commodities, there are slight subtle differences with gold and silver. And finally, when you get into real estate or securities, there's actually a lot of disclosure rules that are necessary because there's more there's more information asymmetry. Cool. So our team, we're a 28-person team now. And 7 months ago, we were 6 people working out of an apartment. We graduated from the cars. And we have a background of technical, financial talents, and we raised about $30 million so far from A16Z Crypto, Block Tower Capital, DHVC, GGV Capital, and a couple of other funds. This is our team right now. We just got back from a culture retreat and had a fantastic time where we also created a roadmap in our mission and vision. And if you're interested in TrustToken's asset or TrueUSD and creating a asset-backed token platform, please reach out to me.
So Nick, if you want to come on up, we'll switch to just grab the chairs over here and let's get set up. Let's switch back to the. All right, get the other mic. something. All right, you guys might want to bunch up so you guys share the mic here. Sure. Okay. So before we jump into some questions that I have, I just want to make sure, do we have any questions from the audience? Oh, okay. Well, I usually am up here to kind of help things with that, but I guess we have let's just go straight to the front here then. Aaron. Oh, yeah. This is the first person I saw. We'll just repeat we don't have an extra mic, so we'll repeat the question. Yeah.
I guess my question for Danny is, because Nick explained how the collateral works, like the connection between the token and the thing that backs it up.
Yep.
So can you explain a little how the dollar backs up the token and what that actually means, and also what the ratios are, like how much backs up? Is it 70% or?
Quickly summarize the question again for the live stream.
Yeah, so the question is, how does TrueUSD stay stable, and how does the US dollar actually back the token? Is that right?
Basically, yeah.
Cool. So fiat-backed stablecoins generally work all the same way, which is 100% backed by the US dollars. And so usually you have an escrow account with a bank partner where they hold all the funds. And so they may be $100 million in that escrow account, and that is backing all of the circulating tokens. And so for us, we allow for redemptions and withdrawals where they go through our web app, go through identity verification, and once they finish that, they can actually wire, let's say, $10 million to the escrow account. The fiduciary then notifies us, and we mint 10 million TrueUSD to that person's wallet. And it's the opposite, where we can burn $10 million of TrueUSD and notify the fiduciary to send $10 million of US dollars back to the person.
And why would they want to do that if they have the money already?
If they have the money in TrueUSD, you mean?
Yeah.
Well, because just like you said, you have a bar where you can accept cryptocurrency, but not TrueUSD. And so there are certain cases where you can use USD a lot more than you can use TrueUSD. And that may change in the future when there's more stores and utility value of holding TrueUSD.
I think this actually kind of goes to a question that I was going to bring up, which is obviously there are different ways of doing a stablecoin. It's all about how to make that peg to the asset, the dollar, the euro. And you guys do have, your projects do have different approaches. And then there's other approaches as well. Maybe one of you guys could explain just for the audience some of the other approaches, like the algorithmic method, exchange-backed. Yeah.
Right, so there's kind of three models here, right? So there is the TrueUSD / Tether / Gemini / Paxos, and what Coinbase is doing with Circle now, where you have dollars backing something, right, one-to-one, and there's a custodian that kind of holds these dollars. You have the model that Maker is doing, right, where it's over-collateralized by assets. Some people like to call this crypto-collateralized. I'm not a big fan of that because it kind of ignores the fact that as more real-world assets become tokenized, all of those things can be used by kind of asset-backed stablecoins, right? And then there's kind of the third approach, which has kind of been penned, the algorithmic kind of stablecoin approach, this kind of dynamic modulation of supply, right, to meet demand. And those would be, for example, Basecoin is, or they're calling themselves Basis now. Basis is an example of one of those.
There was also one back in the day called Nubits, which is historically interesting because they were around for so long back a few years ago.
So pretty much all of them use the same model with a couple of tweaks. They're basically all a model called seigniorage shares, which was envisioned a really long time ago. I personally don't think they really work, but I'm admittedly not probably the best person to ask about these.
Are there any running right now? Because clearly both your projects are live, they exist. Nubits isn't around anymore, Basis isn't out yet. Is there another one?
No, not that I'm aware of.
Oh, we'll just have to wait and see then.
Are you?
No.
Did you have a comment as well on that question? Or is that covered?
No, I think you covered it well.
Well, okay, so now we maybe know a little bit more. Let's do the question there. Are you in the hat?
Hey, in the hat.
So, right now, you're both, so Danny, you're TrueUSD, focused on fiat. Probably, everyone usually is probably used to asking you, what is the low-hanging fruit asset to tokenize? What's on the bottom of that list? Like, what are like some of the most difficult ones that are just completely right out? Most likely because regulatory issues in the US
In terms of creating new stablecoins pegged to really odd kind of price indexes, or what do you mean in terms of collateral?
So real world assets. So I know that I remember hearing that Trust is also focusing on real estate. I'm sorry, that was a different one. But is there a different? I suppose we're just asking about particular assets outside of the usual, like real estate, gold.
If I may, I think what he's saying is, like people, they say, like, you can't just put a blockchain on everything. You know, Bitcoin doesn't do everything. It's really good at some things, but it doesn't do everything. I think the question is, are there assets out there that just don't work for this kind of model? Like you can't peg like you can with fiat or euros, or an example of assets that we just can't. It would be extremely difficult to do this. Just kind of understand the limitations of the technology.
Well, the way that we tokenize assets is we put it in, we change the title of the asset into a legal entity, and we point the ownership to tokens. And so it's basically the same thing as securitization, just with new technology. And so anything that you or I can legally own, a legal entity can own as well, so you can tokenize it. Now, as you get into more complex assets like real estate, there's a lot of issues you have to figure out. Like, what is the voting structure? What are the operational logistics? Who gets to live in it? What's the voting? It's much more complex. And so dollars are the lowest hanging fruit, where it's like dollars sitting in a bank account. You don't really have to vote on it, and there's this redemption and renewal process, and it's all held in an escrow account. If you get into gold, for example, now you have to worry about the operational or logistical custodianship of the gold. And if you want to allow for redeemability on the gold, now you have to ship those gold bars for fungible tokens. And so we think that the way that assets will become more and more tokenized, it starts off with simple assets like currencies, moves into commodities like gold and silver, and then more and more of the complexity gets figured out for securities or real estate.
Would it be fair to say the more physical the asset, the more difficult?
Exactly. Yeah.
Another question? Oh, right up here. Yeah.
Yeah, so two questions. One is how long before real estate can be tokenized, and is there an interest rate associated with that as well that you would pay? And the second one is to monitor those assets. Do you guys both use oracles, and or do you use them differently?
So to answer kind of your first question, kind of about the real estate stuff. Actually, let's start with the oracles. So I actually work on oracles and Maker, so I'm pretty good to ask about this.
Just real quick for anyone who doesn't know that term, oracles, in this context.
So essentially, the problem you have with blockchains is that they're kind of self-contained in terms of the information they have access to. So for example, in a smart contract and a blockchain application, you cannot ping the internet and ask for some information. You have to already have this information on chain. And so kind of the solution to this is kind of what's known as the oracle problem. Where basically you are pushing prices on chain in real time, right? So I have a smart contract and I'm just constantly, say, posting the price of Ethereum to this smart contract, and now any kind of blockchain application can now access that smart contract and get the real-time value of Ethereum. So for example, so for every type of collateral asset that we have in the Maker kind of ecosystem, we need to have oracles that are reporting that price in real time. Because if the price drops, right, we need to know what what the current price is, right? So we know what price to liquidate a CDP at. We need to know to figure out what is the maximum amount of a loan we will extend to someone, right, for a certain amount of that asset. Yeah, and so kind of in the TrueUSD model, I'm guessing you guys don't really need oracles, right? A dollar is always worth a dollar, so they kind of get to avoid this step.
For monitoring property values. For monitoring property, is there a need?
So for monitoring property values, so you mean like in real estate? So that's actually probably what makes real estate so difficult kind of to tokenize, is because there is not a lot of liquidity, which leads to imperfect price discovery. So it's really difficult to kind of source a price in real time, that has small enough latency latency where you can confidently say that this piece of real estate is worth this, right? Let's say you have say some kind of commercial building or a house in a CDP that you're using to borrow against. Let's say that the price of this house or building drops. Now I need to liquidate that. What is the probability that when I try and sell that house or when I try and sell that residential building, which I think someone I was talking to earlier told me it takes about like 30 days to sell a house in San Francisco right now. What is the probability that I'm going to be able to get the quoted Oracle value for that house? What is the risk that I'm taking on in that 32-day period that the value of the house is going to drop? And so that's kind of what makes the whole tokenization and of real estate kind of a much more difficult problem than something like you mentioned earlier, like tokenizing fiat or tokenizing other much more liquid assets like, say, gold.
All right, right there in the chat.
Yeah. So this question is for both of you guys, but of course you gotta answer a little differently. So when someone posts collateral to your platforms, what's the due diligence you guys do on the background? So if someone wired you money, like what is the process to understand how who they are and all that stuff? And then on the collateral side, you could get people who have dirty money trying to get it collateralized. So what do you guys do? Do you see it as a problem? And then on the U.S. dollar side, like we've seen problems in the past with reputable banks that take money from criminal organizations. Like how do you think that's going to affect quality of your tokens?
Yeah, so the question is around how do we do identity verification for things like money laundering? And the second, sorry, I missed the second portion of the question.
Yeah, how do you maintain the quality that it's good, clean money versus...
Gotcha, yeah. Yeah, and so we do the same amount of KYC/ML as banks do. And so we do the KYC/ML as well as our bank partners do the KYC/ML. And so what that includes is that we collect identity documents, usually a passport, or if they're in the States, they can do their driver's license. And then we run them through a set of databases for OFAC or terrorist lists. And if they hit any flags, then we just kind of deny them. Or we may do further investigation and call them up, for example. And so we have a set of policy for that. And once they pass the identity verification, then they can wire in the money. And so they have to do that if they want to wire US dollars in or get wired US dollars to them.
Does Maker have a different technology?
Yeah, so Maker does things quite a bit differently. So on the protocol layer, right, so the actual Maker application, we don't do any KYC or AML directly, right? We want this to kind of be this open financial system. Like, unlike Coinbase, we actually mean that. However, I do definitely see the need for having some kind of regulatory aspect included, but I think it'll come more in the form of the tokens themselves. So what you're seeing right now is for the companies that are exploring tokenizing, say, stocks and bonds, like I'll give an example, Polymath is looking into this stuff right now. Essentially what they do is say that in order to be able to hold, let's say, a tokenized Amazon stock, you need to be on some kind of Polymath whitelist where you have already KYC'd with Polymath. So unless you are on that whitelist, you are not able to send or receive your Amazon stock token or whatever have you. So what I'm essentially saying is these are kind of layer 2 solutions where the tokens that need to get regulated on that front will probably have integrated kind of regulatory models. At the same time, for stuff that's more crypto focused, probably the way this is going to go is with TCRs. It's short for a token curated registry. And essentially, so these kind of have been making rounds in the buzzword circles right now, but it's essentially almost like a curated list by stakeholders that would essentially be enforcing or emulating these KYC AML-like characteristics.
Is there any difference for the other ways of doing stablecoins, like algorithmic, or even the exchange-backed coins, like what Gemini and Coinbase are proposing? Do they have to approach this problem differently? Maybe Danny?
No, they do the same, similar KYC AML. For algorithmic, I'm not sure, but I think they will likely have to do KYC AML because it's predicated by the regulators.
We're referring to like Coinbase and Gemini-backed
Yes.
crypto. All right. Yes, right here.
Two more questions related. What, are you guys doing any kind of taint analysis of the transactions that happen out on the blockchain before they're redeemed? And second of all, why do you think, you obviously think you must not have the problem that Tether had where people were coming after their bank and trying to shut down their banking relationships. What have you done that allows you to be launching something new with public auditing and all that? What have you done with Tether in that regard?
Yeah, sure thing. So the two questions are, first one's around, do we do any blockchain analysis on taint? The second one is around, do we have any differences in how we handle our banking relationships or attestations with our banks? Second one first, yes, we have regular attestations by a public accounting firm called Cohen & Company. So we did that from the very start. We also have multiple bank partners. And so I think being based in the United States and having clean financial record is a good place to start. Maybe Tether had that in the past, or maybe they fudged a couple of spots, and that's why it's hard to get an actual company to audit them. And they've also had bad press, which makes it so that I don't think many companies want to touch them. There's a number of blockchain analysis tools, like Chainalysis and Elliptic, and so we are starting to do taint analysis. There hasn't been really, I would say, regulatory convergence on like how much you have to do. Is it 100 hops out? Is it 10 hops out? But usually what we try to aim for is 1 to 2 hops out of analysis.
So essentially, we are not right, we don't handle any of the conversion back to fiat, right? So if you want to convert your crypto back to fiat, you really have to go to these regulated entities like, Coinbase, Gemini, or Kraken, or what have you, where they're basically doing the KYC AML right there, checking to make sure that the money is clean and not blacklisted, and they're the ones that are basically reporting to, stuff to the government. So we really don't see why, where the onus is on us to handle that on the protocol level. Yeah.
Anybody who hasn't had a chance to ask a question yet? Yes, right there.
Question on the price, USD price. And so it looks like it's never exactly 1.0, right? There's always fluctuation around that. What are the factors that are driving that? And do you see that stabilizing and becoming like near 1? Or do you think the crypto is going to be a little bit marginal difference versus 1?
Sure. So the question's around, if you look at the price chart of CoinMarketCap, it doesn't seem to ever just be $1. What are the factors that deviate off of $1, and do we think that there's going to be more price stability over time? So the reason why it's traded off of $1 is that when you're on exchange, there's an order book where people are willing to sell trust tokens at $1.01 and buy trust tokens at 99 cents. And the way the space works is that usually these are market makers, and so they are the ones that create the order book and are always willing to sell, for $1 for $1.01 because they're making 100 bips. Because they're probably on our web app where they can buy it. They know there's always one place they can trade 1 for 1, and so they have they go out into these marketplaces, you can imagine them, where they're always willing to sell it for more expensive than they can acquire it for, and so over time. Tether actually currently has a large network effect, which is they have a bunch of market makers, and they're all on all these exchanges. But over time, there's going to be enough people that believe that TrueUSD is $1 that it's naturally no one is ever going to really buy it for, let's say, more than $1. There are changes in that, so factors that could change this is when people are trying to get quickly out of Tether, then they're willing to pay $1.05 for it to avoid Tether going to 0 and losing $1 on the dollar. So there are factors like that. There are sometimes when Bitcoin is going down, 10%, and people think it's going to go down 10%, they're willing to pay $1.03. Does that make sense? And so it's a weird thing because it's a dollar, but people, it has utility value of being stable within a very unstable environment.
Yeah, so I agree with everything he said, but so I guess what I want to emphasize though is that it's important to kind of focus on that the stability mechanisms here that are enforcing the peg are kind of reactive kind of mechanisms. So right when the there's a cataclysmic tether event and everybody wants out of tether, right? There's a huge demand shock, right, to get out of tether and buy something that's stable. And so the amount of liquidity that's available on the exchanges, right, for these other stablecoins, isn't enough to meet that demand. And essentially, people are paying a premium, like a risk premium, right, to get out of tether. So with DAI, for instance, right, if the stablecoin, say DAI is trading at like $1.02, what happens is that anyone can, create a CDP, lock up some assets, and basically issue new DAI at a price of $1. So if DAI is trading at $1.02 anywhere, any person can go and basically arbitrage that price difference, right? And you can pocket those 2 cents difference, right? And the bigger the gap is from $1, like let's say, DAI is trading at $1.10 because, there's a crazy bank run on Tether, right? The bigger the profit opportunity is for these, what are essentially, what he was saying, what are essentially market makers. And kind of the same thing happens if it's trading below $1, right? Every single DAI that is out in existence has been created through a loan. And so everyone is kind of looking to pay back their loan, right, if they can get DAI at a cheap rate. So if you can pay back your loan for 95 cents on the dollar, you're going to buy up DAI at 95 cents every single time because what you've effectively done is gotten like a negative interest loan, right? You made money out of taking out a loan. And so it's these kind of dynamic kind of supply mechanisms that are actually enforcing the peg.
So since we have so many questions, I'm actually handing responsibility over to John here. He'll be the one who picks out who gets to talk, because it's hard for me to see people in the back. Be more fair, hopefully. So he's the one to bribe.
I just wanted to ask, maybe what's next for the stablecoin space? Like you mentioned that maybe the end application is to drive e-commerce. So should you be going out there and trying to persuade vendors to start making stablecoins, or what's up with that?
Yeah, like what's the outcome? Where's this going? What are the positive outcomes for this kind of technology? Is that the question? Yeah.
So there's a lot of use cases, and it's difficult to predict. It's kind of a Cambrian explosion where you're making money more efficient. So now you put it on the blockchain, you put $1 on the blockchain, you can send it basically free, basically instantly across the world to anyone that has a private key. And that even in itself is a revolution where there's 2 billion people unbanked, and 90% of them have mobile phones. And so now there's 2 billion people that have access to their own banking, which allows for all the financial infrastructure to be built on top of that banking. Now you have loans, now you have interest rates that you can invest in Bitcoin or crypto, et cetera. And so it's difficult to tell which is going to catch on first, but it's probably going to be the places that have the most need for it. And so we can imagine that hyperinflation countries, we can imagine all the money or all the inventory that's being sent from China into the US that now gets translated into US dollars, but maybe needs to be converted back into renminbi to get back into China to pay the warehouses. There are all these aspects where it's difficult to tell what's the actual next big pull into the stablecoin. For example, foreign exchange is also a big, huge marketplace trading trillions of dollars. Yeah. So it could happen anywhere.
I think Makers, kind of the way that we've built our product is in a way unique in that it allows us a lot more opportunities than other stablecoins may have. Case in point is during the presentation earlier, I emphasized that Maker is kind of this globalized, kind of global decentralized credit system. So essentially, as more assets become tokenized, you can basically start to open up lines of credit against those types of assets. So it's basically like an automated credit system. And so one of the most interesting things that we're looking at right now is we have a partner called TradeShift. And TradeShift is kind of a trade finance company. And what they do is, who here is familiar with something called invoice factoring? That is more than I thought would be. Wow, welcome to San Francisco. So for the rest of you, invoice factoring is essentially if, say you are, someone issues you, you're a small business and someone issues you an invoice, they're usually not going to pay you right away. They'll usually wait 30, 60, 90 plus days before you actually get paid. And that's really a problem for kind of small and medium-sized businesses, right? Because they are dependent on that cash flow, right? They'll go under if they don't get that kind of cash quickly. And essentially what happens is that they're forced to go to the equivalent of loan sharks and sell their invoices for, like 50, 60, 70 cents on the dollar. And even 70 cents is being pretty generous, actually. So there's kind of this disconnect here, right? Where these invoices, a lot of them, I think the statistic is there's about $6 trillion that's locked up in invoices at any given moment in the world. So there's obviously a lot of kind of equity in, kind of credit worthiness in these invoices. So if you can take ones that are very, very low risk, you can actually basically use those tokenized invoices as collateral and CDPs, take out DAI against those invoices, and now give that DAI to the original owner of the invoices. So what you're essentially giving them is a line of credit backed up by their invoices, and essentially what they can do is when the invoice does actually pay out, they can pay back their DAI loan, right, plus a small bit of interest, and get their invoice back, and now cash in for the full value of their interest. So there's an enormous amount of utility that's not currently met by the market that we think we can provide with our kind of unique credit system solution.
I'm going to jump in real quick. This is obviously talking about the future. I am curious, because one thing unique about your two projects is they are out, they're live, people can use them now, which unfortunately is kind of rare in this space. I was curious what kind of real world lessons you guys have encountered, what kind of challenges when things have gone wrong in a way you didn't expect, if you had an example.
Sure.
It's nice to talk about all the good things, but it's interesting to see the perspective of what's happening.
I mean, it's not always just tech is, I guess, what I would focus on, right? So you can focus a lot on having the best developers and, having the most, awesome dev hacks and stuff. And you may be missing, say, the marketing, you may be missing the business development. And so I guess one kind of misstep Maker had early on is that we completely ignored everything else besides the development and said, we're not going to be like these other kind of companies that are just shilling nothing, and we're going to build it first, and then we're going to release it and just kind of wow the world. And it sounds kind of noble, but in hindsight, it would have been much better if we kind of would have kind of established our presence in the space a lot sooner. So I think that would be one of our shortcomings.
Yeah. We kind of went the opposite way, where we just said we're going to ship as soon as freaking possible, and then work on BD and getting it out there on much distribution as possible. There's always prioritization questions, and so one of the things that I think we did was we had incoming interest from more kind of senior leadership positions. And one way to do a startup is you hire a bunch of individual contributors, and then it's built up from the ground up. But since we thought we're going to grow very quickly, and so we'll hire more senior positions, and then they will build out the teams. And some of those are hard to fill out because those senior positions are culturally very important. And so choosing the right leaders in an organization that is about to form is a difficult prediction task. And that's one of the aspects where sometimes it's good to kind of organically grow up with more junior people. I think that's how startups normally start, and then start to have the senior leadership form around what the culture fits into.
All right, let's get back to the fun questions.
I've got one for Danny. So, Nicholas, I think I understand your business model pretty well. Danny, the first slide you showed us was on the crash of Tether. That was called like a little dip from last week. And that was kind of the result of a lack of investor confidence or consumer confidence in Tether and Tether's ability to fulfill needs for cash when people were trying to liquidate their positions. So my question for you is, so if I want to put money into your token, and I want to be confident that you're going to make good on my claim for getting my dollars back when I exit my position. What assurances do I have that the money will remain in the fiduciary account and not be used for funding your business or other claims to that account?
Yeah, sure thing. So the question was, for the money that's sitting in the TrueUSD escrow account, what assurances does everyone have that we can't have access to those funds? And so the number one, our terms and condition give the US dollars sitting in the bank account full legal connection to the token holders. And the way that we do that is that we have fiduciary bank partners that are regulated and compliant, and we are essentially their customers, and to open up the escrow account on behalf of the token holders. And so some of these other exchanges, they've created actually a trust company to be able to do this process. I believe that they're fully owned by the exchanges. And so we don't own these exchanges. They're regulated in the state of Nevada, and so they have to actually be completely separated. So we don't have access to any of the funds actually. We can only say that someone this customer has burned 10 million TrueUSD, and so we can request for them to actually verify that and send it over the US dollars. So we don't have access to the bank accounts at all for the escrow account.
Another question?
Awesome. I have two questions for you guys. The first question, so I understand the need for a stablecoin right now, given the volatility you showed. That said, there's also, I think, an argument that we're pretty early in the adoption curve for crypto. Do you guys see at some point, maybe it's a decade down the road, maybe longer, that Bitcoin or Ethereum, whatever base chain ends up winning out, becomes a stablecoin itself? Obviously, that doesn't preclude your business from expanding. The second question is, have you heard of a over-collateralized Bitcoin-based stablecoin?
I have not heard of a over-collateralized Bitcoin-based stablecoin. Bitcoin is awesome, but Bitcoin is also really hard to build applications on top of. And so I think, the reason why you have seen this kind of a boom in the past, 2 years or so of, companies building on Ethereum rather than on Bitcoin is exactly because of that. That is not to say, though, that you won't see kind of stablecoins collateralized by Bitcoin in the future, right? There are a lot of kind of projects working on kind of interchain kind of communication. So, for example, Polkadot or Cosmos are really trying to be kind of the glue that sticks kind of different blockchains together. So you could, for example, lock up Bitcoins on the Bitcoin chain in some kind of multi-sig, and then kind of have ERC20 Bitcoin tokens floating around on the Ethereum network, right? And then you could use those, for example, in a Maker CDP, right? We could just add that as a type of collateral. As for the threat of Bitcoin and Ethereum themselves becoming a stablecoin, well, with Bitcoin kind of having a hard cap of the amount of Bitcoins that can ever be in existence, I don't think that can ever happen, because there is, fluctuating demand at a fixed supply, right? And that's never going to lead to a stable price. So not really too worried on that front.
Yes, this question is specifically for Danny. Since you're essentially just tokenizing US dollars, I'm wondering what your revenue stream is, where your margins are coming from, and how you're covering
Sure. So the question is, where do we cut revenue from? So we do a fee off of issuance and redemptions. We can also have an interest on the float.
So since we're getting towards the end of the time, we'll do just 3 more questions, and if you could stick to just 1 question per person, that'd be super. All right.
This question is for Nicholas. Do you envision a future where the DAI can be collateralized by an NFT?
I wouldn't say no. Oh, do I see a future where DAI can be collateralized by an NFT?
And an NFT is, yeah.
So,
CryptoKitties. For the audience, people maybe who don't know what an NFT is, real quick for the live stream, real quick.
Okay, it's a non-fungible token, right? So, right, if you have a bunch of Bitcoin, each Bitcoin's kind of interchangeable, right? One Bitcoin is the same as a different Bitcoin. With NFTs, right, they're not the same. Right, so a CryptoKitty that you have is unique to you and is not the same as any other CryptoKitty. Now, in the short term, I don't see us having that. In the medium term, right, I see no reason why, if there is a liquid market for a NFT, so say a CryptoKitty, or say the equivalent of like a blockchain baseball cards or something, right? If there's a liquid market for those assets and you are able to have a price feed for those, then sure, you can collateralize a loan using your NFT.
This question is for Nicholas. How do you prevent a run when there's a margin call on the collateral? You mentioned that there's 1% of Ethereum
Yep.
collateral, but is there like a maximum amount that you would take of any one crypto?
Yeah, so due to time constraints, I wasn't super able to get into all the nitty-gritty details, but effectively, each collateral asset that we accept has a different risk profile. And part of that risk profile is saying, out of the total collateral portfolio, something can only occupy, this percentage of the total portfolio. So, let's say for Omise Go, we only support say 20 million DAI being minted from Omise Go versus because it's higher risk, right? Compared to something like DGX, which is a kind of stablecoin pegged to the price of 1 gram of gold, where right, there's much less risk associated with that, right? As long as you trust kind of their custodian in Singapore. So that's kind of how we manage the different risk of different assets. And so at first, like right now, we've kind of mapped out internally what we think the risk profile is of these assets. But in the future, basically this is going to happen through governance. So we have another token, which I didn't get into earlier, called the MKR token. And essentially the MKR token is a governance token that allows people to vote on these any kind of decisions in the Maker ecosystem, which includes what types of collateral to add and with what risk parameters, right? What interest rate, all that kind of nitty-gritty stuff. And going on your kind of question on a bank run, essentially what happens is, let's say that one token just drops from some price to 0, right? Instantly, just flash crash, done. It's turned out to be a scam or something. I don't know, right? And essentially, right, the first layer of risk management is that you should never have let this risky asset take up too large a part of your portfolio. So say that this, token that went to 0 took up 4% of the total collateral portfolio, right? So all of the loans that are outstanding against that collateral are now underwater. Like, what do we do? How do we back up those loans? And what we essentially do is we dilute the Maker token. So we print new MKR tokens and we auction them off. Essentially, it's a reverse auction saying, hey, we need 50,000 DAI. What is the least amount of Maker that you're willing to accept? And people kind of underbid each other until the auction ends. and then we will mint that amount of MKR to sell to them to get their DAI and basically zero out those underwater loans.
All right, final question. Just to let you know, obviously there'll be lots of time to talk after. We still have beer and everybody can kind of hang around and socialize. But final question, John?
Yeah, thank you both for your presentations tonight and taking the time to talk with us about very interesting projects. My question is about fungibility. So, Satoshi titled his white paper peer-to-peer electronic cash. And of course, 10 years in, we haven't gotten there. One of the reasons, as you both pointed out, is because of the supply and how changes in demand change the price. One of the other reasons why Bitcoin has not become cash, of course, is because of its transparent nature. Because cash is anonymous and cash is private. As somebody else pointed out earlier around taint analysis, you can determine whether or not a Bitcoin has been used illicitly, and there's repercussions for that, which you could say removes the fungibility of Bitcoin. Seeing as how Ethereum operates the same way, what are your teams doing to give users of your currency this same level of privacy and anonymity that cash has?
Okay. So the question is basically how are we kind of helping kind of fungibility of these tokens to kind of, I guess it goes back to a question of like ownership of money, right? So how do you make sure that you kind of keep ownership of your money? And I would say it's simple in that DAI is completely decentralized, right? You can receive it from anyone, you can send it to anyone, no one can censor you. There's no back door where we can just freeze your DAI or just delete your DAI or anything like that. So this is kind of an argument again that kind of separates DAI from all the other stable tokens, is that all of these regulated fiat-backed stable tokens, every single one of them has a back door basically for your money to get frozen. So I would argue that this is kind of a step backwards and not forwards in terms of not really leveraging what blockchain technology allows you to do. Blockchain technology, what the promise is, right? You control your own money and no one can tell you, what, you can and cannot do with it. And I think DAI very much lives up to that promise.
The question also addressed with fungibility, the question of fungibility. As an ERC20 token, you could still track and see the difference in different coins.
Sure, but I think one of the solutions to this is actually kind of going to be privacy sidechains. So most of you probably haven't heard about this, but we recently, or just this week actually, announced a partnership with POA, where we basically made a DAI sidechain. So there's a sidechain now where you can basically, you lock up your DAI on Ethereum, you basically get DAI on the POA network, and now you can rapidly, start transferring DAI around, super, super cheaply at a much higher transaction throughput than you would be able to do on Ethereum. And essentially what you can say is now, well, these sidechains, you can just have privacy sidechains as well, right? Say you want to do some kind of Zcash clone or a Monero clone, right? And run it as a sidechain to Ethereum with basically the Ethereum chain kind of enforcing the kind of security of all that. You can definitely do that, and I think it's just a matter of time.
Sure. I think that using blockchain technology has different benefits. And so one of them could be protection from censorship. Others could be that it sends money faster and more quickly, that it's a kind of global framework that you can build a financial system on top of. And so there's trade-offs with different types of stable coins. So if you're the type that's afraid that there's going to be government censorship of your money, then you may want to lean towards something like DAI. But if you believe more around the idea of having a stable, redeemable for US dollar stablecoin that's transferable across the world at very quick speeds, then you may want to lean toward fiat-backed stablecoins.
I think that really kind of leans to the whole point of this talk, which is that there are many different types of ways of doing a stablecoin. People can hopefully learn the differences. I think in the news and the media, it's kind of sold as stablecoins as one thing, but they're different kinds, and people hopefully can use events like this to educate themselves on the different kinds and figure out which one fits their uses better. So thank you so much for coming up and sharing your time today and helping explain this to everybody. Thank you everybody for coming out, and we'll see you next time.